Hi, everybody, and welcome. Hope you had a good Memorial Day weekend. Looks like a beautiful day here in the DC, Virginia area. Sun is out, so I know a lot of you are tuning in from outside the area, so hopefully you also have nice weather. But this feels like a late beginning to spring here. There's been a lot of rain, a little bit chilly, so we're very excited to finally have some good weather. And we're also excited to be hosting you all today on understanding the tax implications of various investment and account types. I think this is something that clients have the most amount of questions and frankly confusion on, because it is not a simple topic. The IRS code around taxes is anything but simple. So we are going to go ahead and get into it here. It looks like most people have already attended. Before we get too far into it, I just want to let you know that if you have a question, if you click on the Q&A box on your screen, you'll be able to type in your question, and Jeff is on, I'm on, we'll receive that question. We'll save about 10, 15 minutes or maybe even more at the end of the hour, close to like 12:15, to then go through those questions with you. Real quick, can everybody see my screen, see me, hear me? Thank you. All the regulars raising their hand, letting me know they're good. We appreciate that. Excellent. Thank you. All right. So quick disclosure, right? Any mention of performance is, past performance is no guarantee of future results. This presentation is designed to be for informational purposes only. It is not tax or legal advice, right? If you have specific tax accounting questions, you should direct them to your CPA. As financial planners and wealth managers, we certainly do tax planning as a part of what we offer to you as a client. So this is really all about tax planning and how taxes on your investments fit in with the overall picture. But most people, right, they get their 1099 from their custodian, Fidelity or whoever. They ship it to TurboTax or download it to TurboTax or send it to their CPA, and that's it. There's no real understanding of how investment income, gains or losses on investments actually filter through in the tax return. So our hope today is to provide a little bit more clarification, all right, more clarity on that issue, make it a little bit simpler so that you have a framework to understand it. So this is what we're going to be talking about today: tax implications on investment income, tax implication on various account types, comparing those types of accounts, talking about portfolio tax efficiency, estate planning implication when you're inheriting different account types, some recent changes in tax laws, and then we'll conclude with kind of a summary and go into your questions. So again, if you have questions that come up as we're going along, just hit that Q&A button, type in your question. You can, if you don't want your name to show, you'll hit anonymous. If you are fine with it showing, it will show if you don't click anonymous. But I would encourage you to ask those questions as they come versus saving them till the end, because you might forget or you might move on to something that will distract you. So what we're going to start with is just the tax implications on investment income. And as many of you know, what does investment income even mean? Well, it means any return that is generated on the money that you put in, and that could be in the form of interest, right? That's probably the simplest example most people can relate to. If you purchase a CD through your bank, right? That bank is going to pay you, whoops, sorry about that. That bank is going to pay you interest income, and you're going to get a 1099 from the bank at the end of the year, 1099 INT, right? And that interest is actually taxed as ordinary income, which means it's taxed at whatever your marginal tax rate is, right? So that can be anywhere from 10 all the way up to like 37, 39%. Okay. The next type of investment income that's out there is called short-term capital gains. This is the example where you buy a stock, you hold it for 3 months, 6 months, really any time less than a year, and then you sell it, right? Let's say it went up a lot. You say, I'm going to get out, you sell it. Well, that gain is going to be eaten up by your ordinary income tax rate as well, right? So if you're in a high tax bracket and you buy a stock and you sell it and you go, oh, I got a quick 10% return. Well, you may have, but after taxes, it might only be a 6% or 6.5% return. And that's because short-term capital gains, where you hold an investment less than a year, are taxed as ordinary income, just like interest income. Now, where the tax code gets more favorable is with long-term capital gains. That's where you hold an investment for more than a year, right? So if you hold an investment for more than a year and then you sell it, you're actually not taxed at all on those gains as long as you're in the 10 or 12% tax bracket. So that doesn't apply to many people, but it can apply to people after they retire, right? After they retire and their earned income goes to zero and they haven't taken Social Security yet, right? They have the opportunity to reposition parts of their portfolio and actually potentially pay zero in taxes. For every other tax bracket up to the 37%, you're taxed at 15% federal long-term capital gains tax at the federal level. And then if you're above 30 in the 37% tax bracket, the highest tax bracket, it actually goes up to 20% for individuals and families. Okay, still more competitive than ordinary income tax rates, right? Because those you can see here 22, 24, 32, 35, 37, much higher than 15 or 20. And then qualified dividends, same treatment as long-term capital gains. Qualified dividends, most US companies, not all, but most that pay a dividend, as long as you've held the stock for a while, when they pay that dividend, it's going to be taxed as a long-term capital gain, right? So that's called a qualified dividend. There are some exceptions to that we'll talk about, but most, so, bonds don't pay dividends, okay? Only stocks pay dividends. So when it says qualified dividend, that's dividend, right? So you have a company that's revenue, they have their expenses, then they have the money that's left over, that's called their earnings. Well, they can pay out all or a portion of those earnings to shareholders. That's called a dividend. If it's a US-based corporation, it's a qualified dividend. If we have a tax treaty with an international company with tax treaty with the country where there's an international country like a Switzerland or a Germany or UK, most of those are also going to be qualified dividends. And especially if the stock also trades on the US stock exchanges. So one thing we put in here just to kind of get you thinking is if you're in a taxable account, right? Because all of these are only relevant if you're in a taxable account. If you have your money in the TSP or a 401k or 403b, right, or all in IRAs, you don't have to deal with any of this because all of the interest and dividends is shielded from taxes, right, while it's in the account. You can buy and sell and there's no tax consequences. There are tax consequences when you want to withdraw the money, right? And it's taxed as ordinary income. But all of this, what we're talking about here, is where you've already paid taxes on the money and then you go and you invest it. You buy a CD, you put it in your brokerage account, right? You give it to 4J in a brokerage account, we invest it, and then these things start happening. So the question here, a food for thought question, is if you have money that's after tax, you put in a brokerage account, what advantage does a buy and hold have from a tax perspective? So let's say you were to buy a very tax efficient fund. Okay, we're not even saying individual stock, just exchange traded fund that's tax efficient. And you buy it and a year goes by, you don't sell it. 2 years goes by, you don't sell it. 5 years goes by, you still haven't sold it. Well, assuming it's an investment that tracks any major stock market index in the US, over that time period, that investment has gone up materially, but you haven't paid any tax on it because you haven't sold it. So you're essentially able to mimic or recreate the essence of a tax deferred account by buying and holding an investment. Now, there's other things to think about when you're buying and holding investment as to whether that makes sense, right? Not selling it. But from a tax perspective, those gains that are compounding, you're not getting taxed on them because you haven't sold it, right? So it's almost like an IRA or a tax advantaged account, because like an IRA where you're not paying taxes, and the non-qualified account, you're not paying taxes either because you haven't sold it, okay? And that's what we see. Does it remind you of another type of account reserved for retirement funds, like an IRA? Yes. Now it is different because in the IRA, you could sell that position and buy something else and not have any tax consequence, right? So there are differences. But if you're able to have more of a buy and hold patient strategy, you can make that account pretty tax efficient. Another thing to mention on with bonds, right? We talked about CDs and bonds. Bonds pay interest. They pay interest income. There's a particular type of bond called a municipal bond. And a municipal bond is issued by a municipality. It could be the state. It could be a local government. It could be a project like the building of a stadium or a toll road. And those municipal bonds that pay interest are not taxable on a federal level. Municipal bonds are not taxable on a federal level. Sometimes they're not taxed at your state level either. If, let's say I live in Virginia and I'm buying a Virginia municipal bond, I would be tax exempt at the federal and the state level for most municipals that are issued in Virginia. So what you have to look at is normally because of that, municipal bond yields tend to be lower than something like a treasury and other government bond where it's not tax exempt. So, however, if your tax rate gets high enough, right, at this 35, 37%, that's when these municipal bonds can become quite appealing, right? Because if they're yielding 3.5%, but you're between the Fed and state over 40%, well, that's kind of like getting a AA or AAA credit quality municipal bond yielding, 5.5% for whatever duration of time the bond is. So I don't want to get too much in the weeds, but just know that that is another type of investment that does generate interest, but it's tax exempt at the federal level and can be tax exempt at the state level. Okay, so that was all related to investments that you make outside of retirement accounts and they generate interest or dividends or selling capital gains, right? Short-term and long-term. So that all fell into the bucket of taxable accounts that we just talked about. But there's other types of accounts called tax deferred accounts, such as IRAs, 401ks, TSPs, 403bs, SEP IRAs, solo Ks. Those are all tax deferred accounts. Money goes in pre-tax. All of the earnings, interest, dividends, capital gains, grow tax deferred until you withdraw the money out. Then it's taxable as ordinary income. And then lastly, tax-free accounts, right? And that's really Roth IRAs, right? That's the main tax-free account. HSAs would be another one. I mean, this one is tax-free, but I don't think that fits in here perfectly. It's just kind of a rough example. But Roth IRA, HSA, health savings account are tax-free accounts. There's conditions that have to apply, but what that means is the money goes into a Roth after tax. All of the earnings grow tax deferred. And then when you withdraw it out, as long as you've had the account for 5 years and you're 59 and a half, all of the withdrawals you're going to take out will be income tax exempt, tax-free at the federal level, tax-free at the state level. Okay, so now let's kind of compare taxable accounts, tax deferred accounts, and tax exempt accounts. So taxable accounts, right? Brokerage account is another kind of nickname for a taxable account, right? That's a joint account you opened up or an individual account or a trust account. Those are all taxable accounts titled in your name. All right. The money you put into that is going to be after you've paid taxes, right? So post-tax contributions, it goes in. Any interest that's generated or dividends that's taxed in the year that it's paid to you. Capital gains, if it's a unrealized capital gain, aka you haven't sold the position, it's just grown and you haven't sold it, you don't get taxed on that in that year. It's only when you sell the position and realize the capital gain that it flows through onto your tax return, okay, on 1099-B as a capital gain. And if it's short term, not good from a tax standpoint. If it's long term, it is good from a tax standpoint. But either way, there's taxes. So that's the taxable bucket. All right. Then we have the tax deferred. This is where the majority of Americans' money is who have any savings. It's in these tax deferred vehicles because when we get out of school and we start our job, right, we've been brainwashed, and I think it's good brainwashing to say pay yourself first, put 10% of your pay into your 401k or 403b or TSP. Normally you get a match from your employer when you do that. Any contribution you put in, right, lowers your tax liability because you're not taxed on any money you put in. It then grows, right? You can dividends, interest, capital gains realized, repositioning, none of it's taxed as it grows. But, and this is the surprise to a lot of people, at retirement, when you go to start taking that money out, it can be a little bit of a rude awakening if you're not aware of this, how this works, because in order to get $1 out, I may have to actually sell $1.20 or $1.25 because that difference has to go to the tax man, right? So if I need a $10,000 distribution to put a down payment on a car in retirement, and I'm in the, let's just call it the 25% tax bracket, well, I'm going to need to pull out closer to 13, 14,000, right, in order to net myself the 10,000 to actually put down. So the government, right, is a silent interest partner in these tax deferred accounts. And when it comes out, it's all taxed as ordinary income. The tax-free accounts, right, you paying taxes up front. So it's post-tax what's going in, Roth IRAs. Now you can do this with Roth 401ks too. Everything that accumulates is tax deferred and it comes out tax-free in retirement. But you're not getting any deduction when you put it in because it's all after taxes. So these are the 3 different types of accounts. We always emphasize when we do planning, what we really want is to see a split between the taxable and then the tax advantaged accounts. And ideally, you have some money in all 3, right? So that you have diversification from a tax perspective where you're able to pull, if you have to take more money one year because of extraordinary circumstances, you're not pigeonholed into taking that all from your tax deferred account and driving up your tax liability. You could take some from that account, right? And then you could take the rest from your Roth, or you could take the rest from your taxable account. Or if tax rates are really high, maybe you say, well, I'll take out the minimum I have to take out for my IRA, but everything else I'm going to take out from my taxable account or from the Roth account. Or if they're high and you say, I'm not going to take anything from my IRA, I'm going to take it all from my Roth, you can, that's an option on the table too. So having all these accounts is not a requirement, but it's something we like to see when people are going into retirement or in retirement. Okay, so now we're going to get into something that I think is confusing to so many people, including a lot of our clients, and we understand why. And that's specifically around the taxation within mutual funds, right? Mutual funds are pooled investment vehicles where you buy shares in the mutual fund, your money is aggregated with all the other mutual fund shareholders, and then the portfolio manager buys and sells, right, makes investments in different securities and changes it depending on what the market environment is. And the mutual funds we select, we do a lot of due diligence on, and the whole reason we select them is because we believe that manager is able to produce a rate of return that's higher than what we're able to do on our own and with less risk. Okay. Now, having said that, it is important, and this is only relevant in taxable accounts. In IRAs, this is all shielded from taxes. So in taxable accounts, I think this graphic does a good job of explaining there's kind of 2 levels. You're not taxed 2 times, but there's 2 levels of mutual fund taxes. The first is what you as the individual investor do. So if you buy into a mutual fund, it goes up in value and then you sell it for a gain, you'll be taxed at short or long-term capital gains based on when you bought it, when you sold it, right? So that's kind of the first level 1 of the income. The more confusing one for most individuals is this level 2 income. And that is the pass-through income from the underlying mutual fund portfolio activity. When the portfolio manager goes in and buys or sells existing positions, that income, right, those gains that are generated get passed through to the shareholders. Okay. And that is what confuses people because they do get a distribution. You'll see a distribution. It generally comes through in December. Right? Those are gains that were generated in the mutual fund. that shows up as a capital gain distribution, which you are then subject to pay taxes on. And those taxes will be dependent upon whether the position was held short-term or long-term. If it's dividends, right? If it's dividends that generate, then that's going to be, qualified dividends will be taxed at more preferential rates. If they own a lot of REITs, okay, a lot of real estate investment trusts or master limited partnerships, again, we try to stay away from these things, but those are unqualified, non-qualified, ordinary dividends. Those are taxed at ordinary income rates. But the point is, dividends that are generated within the fund do get passed through to you as the shareholder, and capital gains also get passed to you as the shareholder. So sometimes if you have a mutual fund that's really active and has a lot of positions with these really large embedded capital gains, you can be rudely surprised where you buy into a fund and then all of a sudden you haven't even owned it a year and you're getting these really sizable distributions. So you want to make sure you're aware of what the turnover of the fund is that you're buying into. And also what are the embedded capital gains in the mutual fund itself. Okay, so those are the two kind of ways that you are taxed when you own mutual funds outside of retirement accounts, based on what you do, when you buy, when you sell, and then what's happening on an ongoing basis in the mutual fund. One other point of this I want to emphasize, because when people are looking at fidelity.com and they're looking at their statements, the way the statements present themselves is they show you a green or red on unrealized gain or unrealized loss for all positions. Specifically for mutual funds, I think it can be misleading, because that is an unrealized gain or loss only from a tax perspective. It has nothing to do with what your actual performance has been in the account or in that position. And I'll give you an example. If you have a mutual fund that you buy into and they have capital gains distributions, those distributions get sent out to you and then generally gets reinvested back into the fund. When it's reinvested back into the fund, you're buying back into that fund at that prevailing price, which is adding to your cost basis. This gets a little confusing, but it's very possible after that addition is made that you buy in at that higher price. For a while, it actually could show that you have a slight loss in that fund when you don't. You actually have a gain. You have a positive return, but it can show as negative because when that distribution happens and that reinvestment, it resets the cost basis on those shares. So, we can talk to you more about that one-on-one if it's a point of confusion, but I do think it's important to not only rely on those statements when looking at performance and the unrealized capital gain or loss, in particularly with mutual funds. Okay, exchange traded funds are similar to mutual funds in that they generally own many stocks or bonds versus just an individual stock or bond. So they tend to be more diversified. They're very tax efficient because they generally have lower turnover, especially the passive exchange traded funds. They're basically buying these positions that track a particular market or index, and then the turnover is very low, right? But they still are going to have ordinary dividends, qualified dividends, and capital gains distributions. One point on this that is confusing. We buy ETFs that may track a specific part of the market, like treasuries or investment grade fixed income. Okay, that fund is only owning bonds which pay interest. But what's confusing, and it's because of the way exchange traded funds are regulated and classified by the SEC, the distributions that are sent to you are not classified as interest, they're classified as dividends. And that can be very confusing because they, well, wait a minute, I thought this was a fixed income or a bond fund. It is. But it's just that when the interest gets aggregated from all the positions and then sent out to the shareholders, right, it's classified when it's reported to the IRS as an ordinary dividend, which is taxed the same as interest income. Okay, So it's form over substance, but it can be confusing because it really, in substance, is not a dividend. It's interest that's coming from the bonds that that ETF holds. Okay, let's continue with this. We've gone through mutual funds and ETFs. We're going to talk about individual stocks and bonds. So for individual stocks, right, if they pay dividends, if it's an ordinary dividend like a REIT or a master limited partnership or a foreign stock that doesn't trade in the US and doesn't have a treaty, you're going to be taxed in ordinary income rates. Qualified dividends are taxed at the same as long-term capital gains rates. When you sell the stock, right, if it has a loss, that can offset gains. Or if you can't offset gains, that loss can be carried forward to future years. Okay. Short-term gains, less than a year, taxed at ordinary income rates. Long-term gains held more than a year, taxed at long-term capital gains rates. Bonds generate interest income, right, which is taxed at ordinary income rates. Now, you could have a bond that you purchase at on sale, right? Let's say maybe it's a distressed bond, pretty rare. Or you could have a bond where you purchase it when rates are high and then rates go lower, right? That could happen over the next few years. We'll see. Well, you could actually have a capital gain that you could realize by selling that bond after rates went down, the price of the bonds go up. And if you've held it for more than a year, you get the long-term capital gain. If it's less than a year, same thing, short-term capital gain. And then municipal bonds, right? That interest is generally exempt from federal income tax and may be exempt from your state tax if the muni is issued in the same state where you live, or your primary residence is. All right. So now we want to talk a little bit about how we want to think about this from a portfolio standpoint, right? Tax efficiency. So one of the big things we look to do in taxable accounts each year is tax loss harvesting where it makes sense. And that allows us to potentially take gains in some stocks that have been big winners, but offset that capital gain with a loss in another position that went down in value, right? So there was a loss in it. So we could sell both. The losses offset the gains to reduce the net capital gain that you would be faced with, right? Now, there's some rules around how you have to do this, okay? But in general, as long as you're purchasing a materially different security, you can capture the tax law, you can get the benefits of tax loss harvesting and stay invested in the market. Maybe not exactly in what you were in, but in the market as a whole. So we use this a lot where we may have a client who has a really big winner in an individual position or a couple big winners, and then they have other positions they come to us with where the stocks have not done as well. And we can sell both or trim the winner, sell the loser, rebalance into something that's more diversified, more in line with their current investment goals. And that's a win-win, right? Because we're able to decrease their risk. We're able to do it without a huge tax consequence or with a lower tax consequence. And we're able to align them more with what their current goals and objectives are. Asset location. Okay, so this is purchasing different types of investments and accounts that offer the best tax advantage. For example, right, you would never want to own municipal bonds in tax deferred accounts. You might want to own typical interest-bearing bonds in tax-deferred accounts, but a municipal bond should always be in a taxable account because that's the whole benefit. You're getting a lower yield, but it's tax-free. Okay, and then Roth conversions can be a good tax strategy where you're converting money from an IRA to a Roth to convert what otherwise would be taxable to tax-free growth. So on the asset location part, this is a nice piece here that actually Fidelity did. And it's showing you if your global asset allocation is designed to be roughly a 60-40, you can see here, right? Domestic stock is 1, international stock is 2, bonds are 3, short-term is 4. This is just illustrated. We don't have any portfolios allocated like this. But then it's saying, okay, this is the overall mix we want to achieve. But let's let's kind of slice the pie differently depending on how the account is taxed and what the goals are of the account, right? So in the Roth, that's tax-free and generally the longest term in terms of the time horizon, probably an asset or an account you might want to leave to the next generation if possible. So there, right, we have more stock heavy, right? Domestic international stock is most of that allocation. In the traditional IRA, we have the majority of our bonds in there. Why? Well, because bonds generate interest, which is taxed as ordinary income, and that's shielded, right? We don't pay those taxes in IRA. We only pay ordinary income what we take out. And then in a taxable account, we want to have it, right, as much as possible, kind of low yielding, all else equal, okay, from a tax perspective, which would lean us more towards domestic stocks, right? Because they are going to tend to have unrealized capital gains from their appreciation, and then a smaller amount in fixed income. This is not the only consideration, by the way. This is just optimizing your investment mix amongst three accounts purely from a tax perspective, right? We have to factor in other things like how much are you withdrawing from that particular account, right? Because if we have it too aggressive, like this taxable account, and you're withdrawing out, a good chunk, we may have to sell some of these stocks at inopportune times to get you the cash you need. So that wouldn't be ideal either. But it is a good way to think about and understand, why would I want to have taxable bonds in my IRA? Why would I want to have more tax efficient assets in my taxable account like munis or index funds, exchange traded funds, or tax friendly mutual funds? And in the Roth, it's tax free, so that makes sense. I'd want to have majority of that growth oriented. So a lot of our clients, unfortunately, are dealing with parents passing away and they're actually inheriting money. And that's going to be a big story, right? A big thing that happens over the next 10, 20 years is this massive transfer of money to, frankly, existing retirees, and then eventually from retirees to their kids. And it is important to understand, because many people, most of our clients, because of good planning, will be more likely to pass on wealth that they didn't end up using for their life. And depending on the type of account, it's treated differently from a tax perspective to the child or whoever the heir is. So IRAs, right, when you pass away and that goes to your beneficiary, it becomes an inherited IRA. Okay, in inherited IRAs, the beneficiaries must start taking RMDs, okay, based on their life expectancy. But even more so, and we'll talk about this, with the new tax laws that have been passed, they have to actually take all of the money out of that IRA, okay, a kid would, within 10 years following the year your date of death. So if you passed away in 2024, by 2035, all of the money would have to come out of the IRA account. Now, why is that a new rule? Well, remember, any money that comes out of an IRA is taxed as ordinary income, right? So it accelerates the income that you have to get, and therefore the government is going to get from a tax standpoint. It used to be those beneficiaries could take out a minimum amount each year. It would go up slightly each year, but it could extend it out over their entire life. So they, potentially wouldn't exhaust the account for decades. Now, 10 years. Same thing for the Roth, right? That you don't have to take any RMDs as an owner of a Roth, but as a beneficiary, it's tax free, but you still have to take it out. You still have to take it out over that 10-year period. And then for a brokerage account, you get a step up in cost basis at death. What does that mean? Well, if I have a non-retirement account, and let's say I have sizable gains, if you just, kind of look at all the positions overall, it's gone up a lot over my life. I leave it to my kids. Well, they're going to get their cost basis will become whatever the value was as of the date of my passing. It could also be an alternative date, but in general, that's it, which is a huge benefit to the next generation. Because if I had $1 million gain in that account, when they get it, they're going to get it as if their cost base is equal to the current value. So the gain kind of starts over at zero, right, from a tax perspective. And so if they were to liquidate everything basically that day, they could get it all and pay no taxes on it. So it's called a step up in basis at death, and it's very advantageous in general to the next generation. So this was a law that passed just a couple of years ago, Secure Act 2.0, and it changed. Still, we have clients and we frankly need to be reminded as well, but they still think that they have to start taking out money at 70 and a half or 72. But if you're born between 1951 and 1959, your RMDs must begin at age 73. Okay. So if you're born in 1952, you would have to start your RMD by April 1st of the year after you turn 73. Usually we recommend taking that RMD, right? In this case, it would be in the year you turn 73. But technically, in that very first year, you can wait until April 1st of the following year that you turn 73. For those born 1960 or later, you don't have to start taking distributions if you don't want to until 75. Okay. And again, I mentioned this, but the big change from the Secure Act 2.0 was if you're not a spouse and you're inheriting these assets, okay, non-spouse beneficiaries must withdraw all the assets from an inherited IRA or an inherited Roth IRA or any 401k, any retirement account, okay, within 10 years following the date of death. So that is a huge change for people. One, look, it's very beneficial to not be forced to take money out of your IRAs before you need to, because you end up paying taxes, a lot of taxes that, on money you didn't even need. So it's nice that that's gotten pushed back. But clearly the government, right, the Congress is aware that, hey, there's a lot of money here that is up for grabs, and we don't want to wait decades to get it. After this, if a child gets it, they got to take it out within 10 years. And that can increase the tax rate to the child, right? If they're an adult and they're working and they have to take this money out, it changes their tax situation potentially. They could also be strategic and say, well, I'm going to wait and retire 9 years from now, and then I'll take it all out in year 10. And, I'll try to reduce my income tax that way. That may work, it may not, but those are all different things that you need to be aware of. So in conclusion, right, we want to understand different investment types and their tax implications. So that's right. Bonds pay interest, stocks pay dividends. When you sell a stock or a bond or a fund and it has a gain, you pay capital gains. If it's short-term, pay short-term capital gains, which is ordinary income rates. If it's long-term, you get preferential rates. Okay. And then remember, in an IRA, you can move things around, sell things, collect interest. You're not dealing with any taxes as long as it's in that IRA. But when you withdraw out of the IRA, it shows up on your tax return as ordinary income. And you pay federal and state income taxes on that money, depending on which state you live in. The Roth IRA, it goes in after tax, grows tax-free, comes out tax-free, okay, as long as you meet the requirements. Within the portfolio, right, there's different strategies we talked about, tax loss harvesting, right? So being opportunistic about repositioning the portfolio to have losses offset gains. We also talked about smart asset location, right? Having taxable bonds in an IRA versus a taxable account, having munis, right? Munis or more tax-friendly investments in the brokerage account. And then we finished with kind of estate planning considerations. Having your kids listed as a beneficiary of an IRA is totally fine and normal, but you just need to be aware, and they need to be aware that that money is going to have to come out over a much shorter time period than it used to. And we also talked about for your own IRA, you know, if you're born 1951 to 59, you don't have to take the RMD until 73. In 1960 or later, it's been pushed back to 75. Okay. There are other there's plenty of other tax things to think about, right? I talked a little bit about a health savings account. So health savings account is more nuanced. It's only for medical expenses and healthcare related expenses, not all, but most. And those accounts are very unique because they go in pre-tax, they grow tax deferred, and as long as used for medical expenses, they come out tax free. So it's a triple tax free type of account. Another tax advantage account we didn't mention specifically here is a 529 college savings plan. That money, for the most part, does go in after tax. Okay, there's a small state tax deduction that you can get if you use the 529 plan associated with the state you live in. But in general, it's all post-tax. But the gains are tax deferred and will come out tax free if used for a qualified education expense, such as college, trade school, graduate school, and private school K through 12, but you're capped on how much you can take out to $10,000 in any given year. Okay. So let me take a pause there and we will, Jeff, if there's any questions that have come in, why don't we go ahead and start with those? And if you do have any questions you've been holding on to, now's your chance to ask.
All right, thanks, Josh. The first question, it's kind of a comment, really, I think, is for employee-sponsored purchase or stock purchase plans, ESPPs. Stocks have both a long-term holding period plus a 2-year grant restriction period. I don't know if there's a question attached to that or just a point of clarification. When you're going through that slide on the stocks, long-term versus short-term, this is kind of a nuanced, very kind of specific situation for somebody that's still maybe working with that has access to this.
That is. So with employee stock, like restricted stock units, things like that, that's a whole nother deal. Again, there's no shortage of complexity with this stuff, but you could actually have a situation with both, right? You have a restricted stock unit that vests. When it vests, it's taxable as ordinary income. You have to pay taxes on it, but you may choose not to sell the stock. So you have the stock, you're taxed on that stock as if it was ordinary income. But then if you then hold that stock for 9 more months and sell it, you would be taxed as short-term capital gains on the gain portion, right? But if you held that stock for more than a year and then sold it, that gain portion would be at long-term capital gains. So you could have a situation where you actually are paying ordinary income taxes on the first tranche and then shorter long-term capital gains on the next tranche, depending on how long you hold it for. But if you have, I think there has been a client who's been, I don't know who asked that question, but I think we did, we have a more detailed write-up on that we can share for those of you who want that. And I think we've shared it with at least one client.
Okay, we can follow up with that client. Second question. Conceptually, how is the amount of an RMD, required minimum distribution, computed? So maybe just go through the variables.
Yep, that's a really good question, and it's so intuitive for us because we do it all the time, but there's never a shortage of confusion on this. So in general, okay, conceptually, the way it works is when you turn RMD age, so let's say just 73, okay? Let's say I turn 73 in 2024 and I know I'm going to take my RMD this year. The way it would be calculated is I would look at, if I had one IRA, I would look at my December 31st, 2023 IRA balance, right? And then I would go to the IRS uniform lifetime table, which applies to most, but not all people. And in there, next to your age, 73, there would be what's called a distribution factor, I think it's called. You would take the balance on December 31st of 2023 and divide into it that life expectancy factor, that distribution factor, it's generally going to be right around 4%. Okay. And that's the amount that I then have to take out in 2020 by December 31st, 2024 to fulfill my RMD. And you repeat that each year. And the only thing that's changed, two things are changing. The value will be slightly different, okay, each year because market and what you're taking, you have to take out. But December 31st value is the key one of the previous year. And then that distribution factor is going to go, the distribution factor, that number is going to go down slightly each year. Why? Well, you're getting older, so your life expectancy becomes less, which drives the percentage higher, right? 100 divided by 20 is 5. 100 divided by 5 is 20, right? So meaning the older you get, the higher the percentage is that you're going to have to take out. So it's largely stays at that 4% right around their level until 80, then it gets into the 5%, and then it kind of grows, slowly goes up into this, it kind of starts to grow faster as you get into your 90s up to 10%. But that's not money you have to spend. That's money that has to come out of the retirement account, and you have to pay taxes on it. You can choose. We have clients who don't need any of it, and they either reinvest all of it into their brokerage account, or they say, well, I don't really need this, but I don't want to pay taxes on it. And so they actually do a qualified charitable distribution where they send the money to fulfill their RMD directly to a charity or charities of their choosing, qualified charities. And then you actually are able to avoid the taxation on that distribution, whereas you normally would have to pay income tax on it. But because it's going to a charity, you avoid it. So we do that all the time for clients.
Okay, great. The next question, I don't know if this is kind of directly related to the presentation, but it says, can you comment on the taxable nature of Social Security benefits?
Yes. So Social Security benefits in Virginia, you do not pay Virginia. This is my understanding of all of this. You do not pay Virginia income tax on any Social Security benefits received. Okay. The federal government does impose taxes, federal income taxes on Social Security. However, 15% of the Social Security income that you receive will always be excluded from income. It's not taxable. From there, it gets tricky. It's based on a formula, but anywhere from 50% of Social Security income could be taxed, 25% or 0% could be subject to tax. It all depends on your other income sources and your total income that's calculated by based on kind of Social Security income and your other sources of income. But for most of our clients, 85% of Social Security will be included as income on your tax return, and it'll be taxed at the federal level at your marginal rate. It will not show up on your Virginia income tax return.
Right. And the only thing I would add to that is just tying it back to the presentation. If you have, like Josh mentioned, Social Security is always more preferentially treated from a tax standpoint than other sorts of income. However, if you're in the 0% taxation bucket or the 50% taxation, and you're kind of allocating your portfolio or harvesting capital gains or positioning things in high yield fixed income, which generates a lot of taxable interest, that could have impacts, and you could experience a tax cliff where you get pushed up into that next higher tax bracket on your Social Security. So we're not tax advisors, we're not accountants or CPAs. So, but when you're making shifts like that or allocation changes, you definitely want to factor in kind of your current Social Security taxation status, because that could be impacted.
That's a lot of people don't realize when they start taking social, and you can create kind of a tax torpedo effect on yourself without realizing it. And some of you are familiar with Medicare has something called the income related monthly adjustment amount, which is essentially a surcharge tax that gets tacked on when your income goes above certain levels. And that's expensive, right? And so you really want to be thoughtful and work with planners and tax advisors to be aware of what those thresholds are, and if possible, to stay under them. It's not always possible, but many times it is.
Okay, the next one is if a beneficiary is a minor,
Yeah.
do they still have to withdraw from an IRA?
Great
or
question.
Roth within
Great
10
question.
years?
So, sorry, were you done, Jeff?
Yeah, so I got my thinking here, or my understanding is if it's an inherited IRA and the minor is the beneficiary, or inherited Roth IRA with the minor as the beneficiary, is that 10-year rule still applicable to them?
Yeah, so it's not applicable until they reach age of majority, and then the 10-year clock starts. So nothing has to be taken out. This is my understanding, and we're getting a little bit more into the details. But my general understanding of this is if the minor is 10, they reach age of majority 18, those first 8 years don't count. And then the 10-year clock starts when they reach age of majority. Unless they're disabled. If they're disabled, then the 10-year clock never would start.
That's all the questions. Maybe give it
Great
another
questions.
minute. Yeah.
Great questions. If you have other questions that come up, or that you prefer not to share in the group setting and just want to email us, you're more than welcome to do that. And as always, this webinar is being recorded. We'll email it out to you, and it'll be on our YouTube channel for you to watch or to share with others where they may find it useful. But thank you again. I think this is one of those webinars that is just, it is a little bit in the weeds. So some people aren't going to want to, deal with it, because it does get, taxes generally puts people to sleep, but it's super important to understand. And I think it can give people a lot of clarity on what's happening on the tax return. And like somebody asked about Social Security, you'll see Social Security in your tax return will show the total amount, and then the taxable amount, which will be an amount always less than the total. So anyway, we love doing them. We appreciate the opportunity, and thank you all for attending as always. Take care.